Picture this. A shy 6-year-old kid knocks on your door trying to sell you Coca-Cola bottles for a nickel profit. You'd probably think it's cute and maybe buy a pack out of pity. But what if I told you that same kid would grow up to become worth over $150 billion? Not through inheritance, not through creating the next big tech startup, but by consistently winning in the stock market? That kid was Warren Buffett, and today we're diving deep into exactly how he built one of the most incredible fortunes in human history. Most people who try to beat the stock market fail miserably. Studies show that over 90% of active investors underperform the market over long periods. Yet Buffett has been crushing the market for over 7 decades. So what makes him different? What secret strategies did he use that turned a newspaper delivery boy into the Oracle of Omaha? By the end of this video, you'll understand the exact blueprint Buffett used to build his empire, and more importantly, the mindset shifts that separated him from every other investor on Wall Street. Warren Edward Buffett entered this world on August 30th, 1930, in Omaha, Nebraska. The timing couldn't have been worse, just 1 year after the stock market crash that triggered the Great Depression. While most families were struggling to put food on the table, young Warren was getting a front row seat to one of the most important economic lessons of his life. He watched neighbors lose their jobs, businesses shut down, and families torn apart by financial hardship. But instead of being traumatized by the economic chaos around him, Warren became fascinated by it. His father, Howard Buffett, was a stockbroker who had recently lost his job at a local bank. But instead of wallowing in despair, Howard did something remarkable. He took what little savings he had and started his own investment company, selling stocks and bonds. This decision would shape Warren's entire worldview about money, risk, and opportunity. While other kids were playing with toys, Warren was absorbing business lessons from his father's library, devouring books about investing and finance. At age 6, Warren made his first entrepreneurial move. He convinced his grandfather to let him buy cases of Coca-Cola at wholesale prices. Then he'd walk door to door through his neighborhood, selling individual bottles for a profit. This wasn't just child's play. Warren was learning fundamental business principles that would serve him for life. He was understanding profit margins, customer service, and the value of hard work. Most importantly, he was developing an early relationship with money that would set him apart from his peers. The young entrepreneur didn't stop there. By age 7, Warren had expanded his operation to include chewing gum and magazines alongside his Coca-Cola business. He was already thinking like a diversified businessman, understanding that multiple revenue streams meant more stability and profit. While other kids were spending their allowances on candy, Warren was reinvesting every penny back into his growing enterprise. Then came the moment that would define his investment philosophy forever. At just 11 years old, Warren used all his savings to buy his first stocks. 3 shares of City Service preferred at $38.25 each. This was a massive decision for a child who had worked tirelessly to save that money. But what happened next taught him a lesson worth billions. Shortly after his purchase, the stock price plummeted to $27 per share. Most adults would have panicked and sold immediately, locking in their losses. But Warren held on, fighting the fear and anxiety that comes with watching your investment lose money. When the stock finally recovered to $40, he sold, making a small profit. He felt proud of his first successful trade, but that feeling didn't last long. Within months, those same shares skyrocketed to over $200. Warren had sold too early, missing out on massive gains. This experience burned itself into his memory and shaped one of his most famous investment principles. Time in the market beats timing the market. He learned that patience and long-term thinking would become his greatest weapons in the investment world. When Warren was 14, his family moved to Washington, D.C. after his father was elected to Congress. This move introduced Warren to his first real job, delivering newspapers for the Washington Post. But one job wasn't enough for the ambitious teenager. He took on a second paper route with a competing newspaper, the Times-Herald, and worked both routes simultaneously. This incredible work ethic earned him $179 per month, equivalent to over $3,000 in today's money. Instead of spending this windfall like most teenagers would, Warren made another brilliant business decision. He partnered with a friend to buy a pinball machine and installed it in a local barbershop. The machine was so successful that they quickly expanded to 2 more locations. When they eventually sold the business, Warren used his share of the profits to buy something that shocked everyone, a 40-acre farm in Nebraska. Think about this for a moment. At 15 years old, while his classmates were worried about homework and dating, Warren Buffett was a property owner generating rental income from his farmland. This wasn't luck. This was the result of disciplined saving, smart investing, and an understanding of compound growth that most adults never grasp. After high school, Warren wanted to skip college and jump straight into the investment world. But his father insisted he get a proper education. Warren enrolled at the University of Pennsylvania, paying for his tuition with rental income from his Nebraska farm. He later transferred to the University of Nebraska, where he earned his bachelor's degree in business administration. The next chapter of Warren's story involves what initially seemed like a crushing disappointment. He applied to Harvard Business School and was rejected. Most people would see this as a career-ending setback, but Warren's rejection turned out to be one of the best things that ever happened to him. Instead of Harvard, he enrolled at Columbia Business School, where he met the man who would change his life forever, Benjamin Graham. Graham wasn't just any professor. He was a legendary investor and author of The Intelligent Investor, one of the most influential books on investing ever written. Graham's approach to investing was revolutionary for its time. Instead of trying to predict market movements or follow hot tips, Graham taught a systematic approach to finding undervalued companies and holding them until the market recognized their true worth. Warren didn't just study under Graham, he absorbed every word the man said. Graham's philosophy of value investing resonated with Warren's natural analytical mind and his patient temperament. Graham taught him to think of stocks not as pieces of paper to be traded, but as ownership stakes in real businesses with real value. After graduating with his master's degree in economics, Warren desperately wanted to work on Wall Street near the biggest investment firms. But there was a problem. Despite his brilliant mind and extensive knowledge, Warren was still an introverted 21-year-old who was terrified of public speaking. He would literally throw up from nervousness when meeting new people. Recognizing that his shyness was holding him back, Warren made one of the best investments of his life. He enrolled in a Dale Carnegie public speaking course. This decision transformed him from a nervous young man into someone who could confidently present his ideas to investors and business leaders. Decades later, Warren would say that investing in himself was the most important investment he ever made. Benjamin Graham eventually offered Warren a job at his investment firm in New York. Working directly under his mentor, Warren learned the intricate details of security analysis, how to read financial statements, identify undervalued companies, and calculate the intrinsic value of businesses. But as time went on, philosophical differences began to emerge between teacher and student. Graham was purely a numbers man. He focused entirely on balance sheets and financial ratios, treating companies like mathematical equations to be solved. Warren, however, was becoming more interested in the qualitative aspects of businesses, their management teams, competitive advantages, and growth prospects. Graham didn't believe these factors mattered much, but Warren's intuition told him they were crucial. By 1956, Graham decided to retire and close his partnership. Warren had grown his personal savings from $9,800 to $175,000 during his time in New York. More importantly, he'd gained invaluable experience running an investment operation. At age 25, he was ready to strike out on his own. Warren returned to Omaha and founded Buffett Associates Limited with $105,000 from friends and family members. Instead of renting a fancy office, he operated the business from his bedroom, keeping costs as low as possible. This decision reflected a principle he would follow throughout his career. Never spend money unnecessarily, even when you can afford it. Warren's early investment strategy was heavily influenced by Graham's teachings, but he took the concept of value investing to an extreme. He searched for what he called cigar butt, stocks companies that were so beaten down and undervalued that even their liquidation value was worth more than their stock price. Like finding a discarded cigar on the street that still has one good puff left. These investments offered Warren a chance to profit from other investors' pessimism. This strategy proved incredibly successful. Over the next 6 years, Warren's partnership grew from $105,000 to over $7 million. His investors saw average annual returns of 29.5%, nearly 4 times better than the overall stock market performance during the same period. But Warren faced a unique challenge that most fund managers never encounter. He looked much younger than his age. Even in his late 20s, Warren still appeared to be a teenager. Many potential investors couldn't bring themselves to trust their life savings to someone who looked like he should be in college. For over 5 years, Warren ran the entire operation by himself, writing checks, filing tax returns, and managing all the administrative work. Those brave enough to invest with the young-looking fund manager were richly rewarded. By the late 1960s, Warren was managing over $100 million in assets. His track record was becoming legendary on Wall Street, but Warren sensed trouble ahead. Stock prices had been rising rapidly throughout the decade, making it increasingly difficult to find the undervalued companies his strategy depended on. Warren lived by a simple but powerful principle. Be fearful when others are greedy, and greedy when others are fearful. As the bull market of the 1960s reached its peak and other investors became increasingly optimistic, Warren grew more cautious. He realized that continuing to invest other people's money in an overvalued market was too risky. In 1969, Warren made a shocking decision that stunned the investment world. He dissolved his partnership and returned money to his investors. At just 39 years old, he had built his personal fortune to $25 million and could have continued managing money for others. But Warren's integrity wouldn't allow him to take risks with other people. It's money that he wouldn't take with his own. This decision set the stage for the next phase of Warren's career and the creation of his greatest investment vehicle, Berkshire Hathaway. The story of how Warren transformed a struggling textile company into a massive conglomerate is one of the most remarkable turnaround stories in business history. Berkshire Hathaway was a dying textile manufacturer when Warren first encountered it in the mid-1960s. The company's stock was trading at around $7 per share, but Warren calculated that the company's assets were worth at least $11 per share. This made it a perfect cigar butt investment. He could buy it cheaply and profit even if the business continued to decline. Warren began accumulating shares at $7.50 each. He arranged a deal with the company, his management to sell his shares back at $11.50 per share. But when the final offer came, management tried to cheat him by offering only $11.37 per share. This attempt at deception infuriated Warren, and he responded in a way that would define the rest of his career. Instead of accepting the lower offer, Warren bought out the entire company and fired the management team that had tried to cheat him. While he got his revenge, Warren now found himself owning a textile business that was steadily losing money. But instead of cutting his losses, he made a brilliant decision that would change everything. Warren decided to phase Berkshire Hathaway out of the textile business and transform it into a holding company for his investments. This structure would allow him to buy and control other businesses while using their profits to fund additional acquisitions. It was a revolutionary approach that would eventually make Berkshire Hathaway one of the most valuable companies in the world. The transformation of Warren's investment philosophy came through his partnership with Charlie Munger, who became his longtime business partner and closest advisor. Munger influenced Warren to evolve from buying fair companies at great prices to buying great companies at fair prices. This shift in thinking opened up a much larger universe of investment opportunities. Warren began searching for companies with what he called economic moats, sustainable competitive advantages that would protect them from competitors over long periods. The metaphor came from medieval castles, which used water-filled moats to keep enemies at bay. In business, economic moats could be strong brands, unique products, cost advantages, or high barriers to entry for competitors. One of the best examples of an economic moat was Coca-Cola. The brand had been building customer loyalty for over a century and had achieved something that competitors found almost impossible to replicate: instant global recognition and emotional connection with consumers. When people thought of soft drinks, Coca-Cola was usually the first brand that came to mind. Using this new investment philosophy, Warren began buying large stakes in high-quality companies through Berkshire Hathaway. The stock price of Berkshire itself reflected this success, rising from $11 per share in 1965 to over $290 by the late 1970s. Warren's personal net worth had grown to around $240 million. But his greatest wealth-building strategy was yet to come. The key to Warren's massive fortune was not just picking great stocks. It was leveraging the insurance business to supercharge his returns. Insurance companies collect premiums from customers regularly, but they don't pay out claims until later. This creates what Warren called float, large amounts of cash that could be invested while waiting to pay future claims. Starting in 1967, Warren began acquiring insurance companies through Berkshire Hathaway. He bought National Indemnity, followed by Central States Indemnity, and eventually GEICO. These acquisitions gave him access to billions of dollars in float that he could invest in stocks and other businesses. The beauty of this strategy was that Warren was essentially getting paid to invest other people's money. Insurance customers paid premiums to protect against future risks, and Warren used those premiums to buy stakes in profitable businesses. As long as his insurance companies remained profitable and his investments performed well, he could compound wealth at an extraordinary rate. With billions of dollars in float at his disposal, Warren made some of his most famous investments. In the late 1980s, he purchased 7% of Coca-Cola's total stock, eventually making Berkshire Hathaway one of the company's largest shareholders. This single investment would eventually be worth tens of billions of dollars. By 1990, Berkshire Hathaway's stock was trading at around $7,000 per share, and Warren's personal net worth exceeded $1 billion. He had achieved something that seemed impossible, consistently beating the stock market over decades, while building a business empire that would outlast him. The scale of Warren's success becomes even more impressive when you consider his personal habits. Despite being one of the richest people in the world, Warren continued living in the same house he bought in 1958 for $31,500. He drove modest cars, ate at McDonald's for breakfast, and avoided the lavish lifestyle that most billionaires embrace. This frugality wasn't about being cheap. It was about understanding the difference between price and value. Warren spent money on things that provided genuine value while avoiding wasteful expenses that contributed nothing to his happiness or success. He famously said that his biggest luxury was having the freedom to do what he loved every single day. Over the decades that followed, Berkshire Hathaway continued acquiring and investing in high-quality businesses. The company bought everything from furniture stores to railroad companies, always focusing on businesses with strong competitive positions and capable management teams. Warren's insurance operations provided the capital, while his investment acumen ensured that money was deployed profitably. The 2008 financial crisis provided Warren with another opportunity to demonstrate his investment philosophy. And while other investors panicked and sold their holdings, Warren saw the crisis as a chance to buy great companies at discounted prices. He invested billions of dollars in banks like Goldman Sachs and Bank of America when their stock prices were severely depressed. These investments during the crisis generated enormous profits as the financial system recovered. Warren's willingness to be greedy when others were fearful once again proved to be incredibly lucrative. His net worth continued climbing, eventually exceeding $150 billion and making him one of the wealthiest individuals in human history. Throughout his career, Warren has emphasized that successful investing is not about being the smartest person in the room or having access to secret information. Instead, it's about developing the right temperament, being patient when others are impatient, being fearful when others are greedy, and being greedy when others are fearful. Warren's investment principles can be distilled into a few key concepts that anyone can understand and apply. First, invest in businesses you understand. Warren avoided technology stocks for decades because he didn't feel he could properly evaluate their long-term prospects. Second, focus on companies with sustainable competitive advantages that can protect their profits over time. Third, think like an owner, not a trader. Warren buys stocks with the intention of holding them forever, which forces him to choose companies carefully and avoid short-term speculation. Fourth, use market volatility to your advantage by buying when prices are low and avoiding purchases when prices are high. Finally, Warren's success demonstrates the incredible power of compound interest when combined with patience and discipline. He didn't get rich quickly. He got rich steadily over many decades by consistently making good decisions and letting time do the heavy lifting. The Oracle of Omaha. The story teaches us that extraordinary wealth does not require extraordinary intelligence or access to insider information. What it requires is discipline, patience, and the courage to act differently from the crowd. Warren Buffett turned these simple principles into one of the greatest fortunes in history, proving that sometimes the most powerful strategies are also the most straightforward. Today, at over 90 years old, Warren continues to manage Berkshire Hathaway and search for great businesses to buy. His legacy extends far beyond his personal wealth. He has inspired millions of investors to adopt a more thoughtful, long-term approach to building wealth. The shy boy who once sold Coca-Cola door to door has become one of the most respected figures in the business world, proving that with the right mindset and approach, anyone can achieve extraordinary financial success. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.